If let's say Singapore, right now we got some extra cash, right? What kind of investment should we be looking into?
Firstly, establish whether is it additional cash. Where do you get the additional cash? Is it because last night you strike Toto? Last night you strike 4D? You receive an inheritance? Is it a once-off? Or potentially in the future you always have this amount of cash? That is establishing the source of fund that you have. When it's a sum of money that comes in, you can decide, I can splurge on myself. This is something that I've been wanting to do for a very long time. I want to go and take a tour. By all means, if it's something that is surplus, go into it. If your objective is to gain, how do I turn and leverage this into a bigger amount? Of course, I can't leverage it into the next day. I don't expect, oh, today I have $1,000. Tomorrow, let's make it into 2,000. The day after, I make it into 4,000. That's unrealistic. If we give it time to grow, then this amount can potentially turn into 10,000. Conversely, if we scale it up, 10,000 to 100,000. It's just a scalability issue. Or even if we bring it lower, 100 to 1,000, 100 to 2,000. The question here is, what vehicles can you use to bring this amount to increase it to a certain value?
Okay, so if you're talking about all these different vehicles, right, can you like name a few vehicles and what's so different and unique about them?
There's a lot of financial asset classes that we can invest in. When there's different financial asset class, we have to keep in mind a few important factors. The risk, volatility of it, liquidity of it, and the time needed for it to invest in. Try to maintain these 3 points. The risk, the liquidity, the time horizon. First, I touch on risk. Do I want to add a bit of risk so that I get a higher returns? Or if I'm not such a risk taker, I'm a risk averse person, I just want to have a stable returns. That is one point. Liquidity of it is, if I put into a certain investment, how can I convert it back into cash? That is liquidity. How fast can I turn it back into cash? Let me give you an example. I put into a fixed deposit at a certain percentage. There is liquidity in this. Why I say so? If I keep it a tenure for a year, the time horizon is 1 year at a certain returns. If I need to use this cash amount, I can just go back to the bank. I want my money back. There is no risk. The bank will just return me immediately on the spot or probably 1 day later because of the processing. I will get my capital back almost immediately. The only drawback is because I'm unable to fulfill that 1 year tenure, I lose the interest amount that they were giving me. Compare this to versus a property. I put a certain amount in to buy a property. This amount, I can only liquidate or I can only exchange it back into cash when someone agrees to buy my house. I have to go through the legal processing, which will take months or even take years. Whether am I able to get my desired selling price is an issue. Cash flow is what we hope to achieve in all circumstances. Everybody knows I have more money coming into my pocket than the money that I spend out of my pocket. I'm good. The problem is a lot of people have a certain amount of money coming into the pocket, but they spend a bigger amount out of their pocket. When it becomes this kind of scenario, it actually becomes a vicious cycle. Why I say so? X amount coming in, Y amount going out. Your Y is bigger than your X. Forever you'll be in a debt and it's a vicious cycle spiraling down. What we want is cash flow coming in, X, bigger than the amount going out, Y. And then it will actually become a virtuous cycle to get more and more money in your pocket. By having this additional amount of money in your pocket, and you do it in the right vehicle, do it in the right portfolio, this will prove the word money makes more money. And who is the ultimate beneficial in the end? You.
So with this itself, let's say when this money makes money, right? So, what are the wealth management strategies that you would recommend?
Before I even touch into this, you have to understand yourself. What I mean by understand yourself, you have to know what is the investment objective that you would like to have, how much returns you would like to have, how much you want to see this money grow into. That is your aim, investment aim. Number 2, how much risk that you can stomach. And number 3, what is the time horizon that you are putting in. If you set a certain time horizon already, and you have a strategy to tag along this time horizon, stay on course with the strategy. It's not a question of whether the investment can achieve the returns yields at the end. It's because people are unable to follow through the investment strategy. When people cannot follow through the investment strategy, they say, oh, this investment is a lousy investment. But actually, you really need to give it the time that you set to decide whether this investment is viable for you or not. So just now, as I say, what are the things that we can invest in? We can look into stocks and shares. Of course, you can invest into local stocks or overseas stocks. When you go in, you must think of your mindset. A lot of people go in with the mindset of an investor mindset. What I mean by an investor mindset means I go in at a low price, I sell at a high price, meaning giving me a capital appreciation. Of course, I can do my own research on the shares that I want to buy. Nobody can time the market. Time in market is better than timing the market. You do not just buy a stocks and over the next few days, next few months, or next few years even, hoping that it will just shoot up to a capital price point that you like, and then you sell off, make a capital appreciation. What you want is give it a reasonable amount of time horizon, even if there's fluctuating in between. When we talk about share price, it goes up. If there's vibrations along the way, are you going to chase those vibrations that may profit or make a loss for you? If you do a quick exit out of it, thinking that you have made a profit out of it, the question is, if I stay on the whole horizon, would it make me a bigger profit? If I get out thinking that it was a loss, of course, in the future, there may be a bigger loss, but markets always go up and down. When the market recovers, can it reach even a higher point for you?
With that said as well, since you talk about like different kinds of like stocks and shares, is there something that's not as volatile?
Besides stocks and shares, there's something that's not volatile is definitely commodities. What I meant by commodities, things such as oil and gas, staples such as your rice, sugar, corn, precious metals, gold and silver. The volatility may not be fluctuate as fast as stocks and shares, but it's still volatile. Huh? Commodities, as an investor, you need to buy in bulk volume. It's not like you go to Sheng Siong, you go to NTUC. When I talk about rice, we are not talking about 1 kilogram, 10 kilogram, 100 kilogram even. We are talking probably about 1,000 tons of rice, 1,000 tons of sugar, a marine cargo load of commodities. That's for staple. If you want to trade in oil and gas, imagine the amount that you have to pump in. What's oil prices right now? That is per barrel. If you're talking about 1 million barrel and the capital outlay, as an individual investor, this will unlikely be the thing that we can invest in simply because we do not have this amount of quantum with us. Gold, you can still do a bit because there's a trade market and a retail market. When it's trade market, we cannot involve, we can't join in there. But when it's a retail market, you can just go over to any gold and pawn shop and buy small pieces of jewelry that you want.
When it comes to, I have some gold already, I invested, but I still have some amount of money left behind that I want to kind of make it grow. And these are money that I don't mind not touching for long term, just sitting in the bank and getting nothing. What do you recommend I should start looking into?
If I understand you correctly, you have a certain amount of money in the bank. Bank is still earning interest. So there's still some returns. But the question is this return able to beat inflation? If your interest is 2%, your inflation is 4%. The longer that you keep the money in the bank, the amount of spending power, spending value of this money is going to get lesser and lesser. Then I would rather you just spend away now. Because you've got a bigger spending power now rather than 10 years down the road. The same amount of money, if you spend it now, you have a bigger spending power versus if you spend it 10 years down the road. The only way to reverse this thing around, this amount of money in absolute terms, in absolute value, must increase to be bigger than inflation, to be faster than inflation, such that the amount of value of money in 10 years' time, you're able to get more things, you're able to buy more things, then that serves justice to this amount of money that you have right now. When we talk about different asset class, again, it has to understand yourself. What are you looking for? If you just want to see a value increase, that's called capital appreciation. If you park this amount of money from point A to point B, give you some returns along the way, something that you can spend on along the way, which would you prefer? Because only when I understand you more on what are you trying to achieve, what do you want, I can give you my suggestion or my opinion of how to do it, which asset class to do it. It's something that is suitable and personalized for you.
In your experience, right, what kind of investment asset class has worked the best for you?
Personally, for myself, even though I'm with a financial institution, I do not hold all my asset class in one basket. I also own a multiple basket of assets. Primarily, I have multiple properties. That's number one, to give me my accommodation, serve my basic need. Number two, I do have some stocks and shares. When these stocks and shares I'm buying in to give me the appreciation, but the amount that I put into stocks and shares are something that I can afford to lose and something that I will not lose sleep over it, even if I lost it. It's also been achieving me great returns over a long term. I must stress, over a long term. We are not talking about today in and 1 year later it double the amount. We are very realistic here. And of course, the third one I have is what we call a dividend paying vehicle, meaning I park my a certain amount of money in, and this amount of money actually give me regular returns regardless of market condition. What we wanted to achieve here is something that no matter market bullish or market is bearish, it will just give me a certain amount continuously. With this additional amount, remember, this additional amount is actually the basis of my other investment. Because my family don't need this additional amount, it is not my occupational income, it becomes a surplus amount from the surplus amount. Right now, you have a surplus amount. How do you ensure this surplus amount is stable and can give you an additional surplus amount? When this happens, you have actually a surplus on your surplus. When you achieve this surplus, you are able to invest into higher risk product. Thereby, when you reach that stage, when you risk into higher risk, it does not affect your baseline. And you are very sure that no matter the market is up or down, you already had an income on top of your occupational income. And that is where we call the investment segment.
Thank you for sharing that. And yeah, so if let's say you were to wrap this up, right, for your clients, how would you advise them? What are the 3 aspects that you usually focus on for your clients?
Always bear these 3 things in mind. Assets, something that you build upon, something that will keep on giving you additional cash flow. It can be financial asset, emotional assets, relationship, or other things. Over here, we talk about only financial assets. But bearing in mind, in life, there are other things that is included in your life as well. Liabilities. Financial liabilities is something that will always make a hole in your pocket. Your money will leak out from the hole in the pocket because of these liabilities. That is why you must always ensure that when your money going in is bigger than the money going out, then you can hold water. Ma. If the money going in is lesser than the amount going out, you will not have the water or the money in your pocket. That is where I come to the third point. When you build up a reasonable good amount of assets as your base and you're able to control your liabilities, that's when you have cash flow. Very simple logic. A bigger assets than your liabilities, you will have a positive cash flow to build back onto your asset. This positive cash flow will be able to, in turn, build more assets. Thereby, you'll actually be going into a virtuous cycle spiraling upwards for yourself.
So now, thanks for sharing all this, and I learned a lot. What do you have planned for your next videos?
Today, I touched a little bit on assets building, the type of classes of assets that you can build upon. In future videos, probably, if what I say resonates with you, you can always follow me. And in future, I probably touch a bit on liabilities and how these different sort of liabilities can affect a person's personal wealth. Ultimately, we want to build a cash flow. So those are the topics that I will touch on in future. Along the way, I hope that such videos will be able to help people manage their wealth better, understand themselves better, their earning capability, that's your asset. Your spending habits, that's your liabilities. And what you want to achieve is positive cash flow.